Morning, ladies and gents. Hopefully you can hear me okay at the back and I'm not being too loud. So just to get into it, we're going to be talking about what is the correct tax structure for your property business. Okay. A bit about me before we get into the detail. So that's me, Sean Hughes. I've been a chartered tax advisor for a number of years, working in tax since 2008. And all we do is property taxation for landlords. We've been doing this Birmingham show for the past 4 or 5 years now. And we're not here, myself and my colleague Becky out there, who's also a chartered tax advisor. We're not here to sell you one particular product. There are 4 key ways of holding your properties in this day and age, and which one's right for you will depend on your circumstances, and we'll go on to that in a moment. And just to be clear, we're not accountants. You know, we are quite boring, but we're not as boring as accountants. So we're not looking to do your tax returns year on year. We just give specialised advice to property investors and work alongside your accountant. Okay. So what we're going to cover, we're going to do the brief overview of the issues facing landlords from a tax perspective and just give a brief overview of them. We're going to mention Section 24. It's been in now for a few years, but just so everyone's on the same page, we'll go over it. And then we'll talk about the different tax structures that are available to hold your properties, pay the lowest amount of tax, and keep as much wealth as possible. Okay, so 4 key things that landlords should be looking at. Whether you do business with us or not, these are the 4 key things you need to be thinking about. Stamp duty land tax, SDLT. The first thing to say is the solicitor that acts for you on purchasing a property, more than 99 times out of 100 is not a tax advisor, okay? If you look at the contract between yourself as the purchaser and the solicitor acting for you on that purchase, there's normally a clause in there that says, if you want tax advice, seek it independently because they're not qualified to give that advice, okay? So you should always question what your solicitor is doing in terms of stamp duty. In particular, if you're buying dilapidated properties, okay? There's a few different companies here today at the trade show saying you can reclaim stamp duty if you've bought a dilapidated property. It's absolutely correct. If the property was not suitable to live in on the day of completion, then you should not have paid the additional 3% surcharge. Unfortunately, the legislation hasn't evolved enough yet to give a clear, concise definition of what unsuitable as a dwelling actually means. So there is some grey area, so you need to be careful, not put in elaborated claims, because you can put in claims to HMRC. They will repay it almost automatically in some cases, but they still have potentially 9 months definitely, or 4 years to ask for the money back. So if you're going to one of these reclaim companies and they're getting the money back, taking your fee once they've got it, you need to be aware that if they've not made full disclosure, HMRC have still got 4 years to come back and ask you more questions and maybe ask for the money back. Now, if in 4 years' time, that other company or those companies are no longer in existence and you've paid them that fee, but you've got to pay it back to HMRC, you're going to be the one footing the liability. So you've got to be very careful about doing claims that are legitimate from the outset and dealing, in my opinion, although I would say this as a professional, dealing with chartered tax advisors who have to give objective advice. And we make full disclosure to HMRC, and that limits their inquiry window on stamp duty to 9 months, meaning once that 9 months is over, the money is safe in your back pocket. Okay. If you've bought any mixed-use property in the past 4 years, you'd be surprised the amount of times that solicitors charge the residential rates of stamp duty when it's a mixed property. And when I say mixed, what I mean is some commercial aspect to the property, be that a shop, an office, some retail space, and some residential aspects as well. If there is even 1 square foot of the property that is not residential, then it can be classed as commercial for stamp duty purposes, and that means the 3% surcharge does not apply, okay? So again, we've done a lot of reclaims in that area. The other big one at the moment and I believe the rules will change on this in the next year or so, is where you buy a commercial property, let's say it's normally a shop, and then 2 or more flats above that shop or included in the transaction, you can actually get the stamp duty down to 1% rather than maybe 2, 3, 4, 5%. So we're doing a lot of work there as well, and like I say, the savings can be really, really good in that scenario. Also, if you've moved property from personal name to a limited company, you again see it all the time. Solicitors normally just charge you the full amount of stamp duty on that transfer without asking any questions. If you come to us off the back of this seminar and say, Sean, I've moved a property from my personal name to a limited company, I'll ask you 3 or 4 questions that your solicitor didn't ask you, and depending on your response to those questions, we may be able to get a full refund of the stamp duty. Okay? Is the sound okay, Sean? Yeah, cool. Okay. Also, if you've bought from the executors of a deceased person in the past 12 months and you plan to flip the property and not spend too much on the refurb, along with a couple of other criteria, then again, you maybe shouldn't have paid any stamp duty whatsoever. Again, anything like that, come and have a chat to us. So that's stamp duty. How you structure your business is what we're going to talk about in the main body of the seminar. All I'll say on this is your accountant is maybe not a tax advisor. The analogy I give is that accountants are like your GP, they're like general practitioner doctors, okay? They have to have a very broad knowledge of a lot of things, but it's very shallow, okay? As a specialist, a property tax specialist, if I can call myself that, I have a very narrow area of focus, but it's very deep, or at least I think it is. So we give the specialist advice and work alongside your accountant. We're going to talk about limited company, LLP, partnership. Staying as you are can sometimes be the correct way to go, but we'll come on to that later. Very briefly on capital allowances. What qualifies? If you've got commercial property, furnished holiday let, service accommodation, parts of that building will qualify for capital allowances. And what that means is a value attributable to those assets, like lighting, air conditioning, hot and cold water systems and so on. You can get a tax deduction in the year of purchase for the value of those assets, okay? Compare that to buy-to-let property, whereby you only get a deduction for the value of those assets when you come to sell the property, okay? So in a nutshell, that is what capital allowances are. At the moment, it's a good time to claim. If you're incurring expenditure at the moment, there is a super deduction of 130% rather than 100%, kind of one of the measures to kind of stimulate the economy after COVID. So again, if you're spending money on furnished holiday lets, commercial property, then definitely come and talk to us about that. Inheritance tax planning, just talking about this rather briefly. You don't want to build up a portfolio during your lifetime, pay added income tax through Section 24, and then when you pass away, your children have to pay 40% of your wealth to HMRC. So what can you do to avoid that? Well, you can use trusts. And again, it's a bit of a minefield. There's so many different types of trusts that can be applicable. Interest in possession trust, discretionary trust, bare trust, EBT. Which one's right for you completely depends on your circumstances. Some other companies, one of which is here today, claim that if you put your portfolio into a limited liability partnership, after 2 years it will magically qualify for something called business property relief. That will mean your kids pay no inheritance tax when you pass away. In my opinion, complete load of nonsense for the majority of people here today. Landlords, there was a court case a few years ago where it was like a stately home with stables and grazing land and a bit of B&B stuff, and that qualified for business property relief. But looking around the room, I probably think the vast majority of you are not in that situation. You've maybe got 5, 10, 20, 30 normal buy-to-let properties, a couple of HMOs, maybe some furnished holiday lets. That will not apply to yourself. You will not get BPR, in my opinion, and you have to do other inheritance tax planning. Gifting assets, you can gift during your lifetime, but there are capital gains tax implications, and can be inheritance tax implications as well. There are certain exemptions. You know, you can give away £3,000 a year to your children or grandchildren with no issues. And then the other one that I've not put on the slide, but is very good, is, and not many people know about it, is where, say you've got an elderly gentleman and, you know, they've built up some wealth throughout their lifetime. They're maybe still getting in, I don't know, £50,000 of clean profit every year. If that gentleman is only spending £20,000 a year to live off, then that £30,000 of income that he's not spending, he can gift that to his children or grandchildren or great-grandchildren with no inheritance tax implications. And it's a really relatively simple, easy way of just, you know, not adding to your inheritance tax exposure. It's called regular gift out of income, and, you know, it's not well known enough in my opinion, so that's why we bring it up here. Okay. So, right, before we get on to the main bit about how to structure your property investment holdings, the big driver as to why people have, you know, looked to restructure over the past 5-6 years is because of Section 24, okay? Many of you are probably sick of hearing about Section 24, I am as well, but basically Section 24, it means you no longer get full deduction for your mortgage interest payments if you are holding residential property in your personal name, okay? So, just as by way of an example, the last year that, you know, being a property investor was straightforward from a tax perspective was 2016-17. In this example, we've got rental income of 100 grand, interest of 40 grand, other expenses, repairs, letting agents fees and so on of 25, your profit of 35 grand, and at that time, assuming the personal allowance we used elsewhere, it would all be taxed at 20%, okay? Pretty straightforward, pretty easy to calculate, okay? But then you roll it forward to the tax year that ended April 2021, and Section 24 is fully in at this point. It was phased in over a number of years, but now it's fully in. Same example, rental income of 100 grand, but you do not get a deduction for your interest payments at this stage, okay? You still get a deduction for your letting expenses and repairs and so on. So now your fictional profit is now £75,000. 35 grand is still taxed at 20% in this example. The remainder is taxed at 40%, okay? Leaving a liability on that of 16 grand. And what happens to the interest? This interest of £40,000 gets a 20% credit, so £8,000, to come off your liability, okay? So a 7 grand liability has turned into a £15,000 liability based on the same numbers over 4 years, okay? So like I say, this is a key reason a lot of people have acted over the past 5 years or are still thinking about acting because of this additional liability, okay? So the effect of Section 24, as you can see from the example, is that it pushes some into the higher rates of tax, and in that example, the additional tax was 20% of the mortgage interest payments because they were effectively taxed at 40, but getting a deduction at 20, the net result is you're effectively paying 20% on your mortgage interest payments, okay? Is that relatively clear to everybody? Yeah. Yeah, a few nods there, that's cool. The gentleman just asked, are the slides available? There's a piece of paper on your chair. Just if you want to fill in your details, pass it to me at the end of the seminar, or I'm just the other side of the curtain here. Just pass it to me, we'll send you the slides, no problem. And also, if you want us to contact you after the seminar or tomorrow or whenever, we'll drop you one email. You know, we don't chase people. Drop you one email. If you want to have a conversation about anything we talk about here, then we'll go from there. Right, so moving on to the main body of the presentation. We're halfway in. The tax structure. What tax structure should you be holding your property in? Now, there's no holy grail, as it says on there. There's no one size fits all. It all completely depends on your circumstances. We're going to run through a few examples in a moment, but any advisor or company that's suggesting everyone go into one of these structures, like an LLP hybrid structure or something like that, or somebody saying move all your properties into a limited company, they're almost certainly wrong for the vast majority of people, okay? So, real world examples. and this is probably the most common one actually. I do presentations like these at trade shows like this. People get in contact, say they think they're paying too much tax because of Section 24 and the example I gave at the start. But if you're not a higher rate taxpayer, even after you've not got a deduction for your interest payments, you are not affected by Section 24 because you still get that 20% credit, and if you're only paying tax at 20%, they kind of net themselves off, okay? So in that situation, if you're not a higher rate taxpayer, from an annual taxes point of view, staying as you are is probably the right thing for you to do. The only reason for maybe changing it is maybe for a commercial angle. If you're bringing, you know, a child or a partner on board and sharing the profits with them, like we'll talk about in a moment, or if you've got an inheritance tax issue that you want to, you know, reduce your estate, even though you may be still a basic rate taxpayer, that's the only other reason we maybe give to move to a different structure than just staying in your personal name. Because if you stay in your personal name, you don't have to pay any fees to professionals like me, and mortgage interest rates are still lower when you're holding property in your personal name or a non-corporate entity. So it makes no sense to do anything really. So that's that. The next one, general partnership. Again, relatively straightforward. So I think the example I've got here, somebody at one of these trade shows came to me, said they wanted to incorporate, to move the properties to a limited company. They didn't meet the criteria, which we're going to talk about in a few moments. But throughout the conversation, you know, his wife was there with a baby. She was not working at the time, and she wasn't planning on going back to work, which meant she had a 12.5 grand personal allowance and then 37.5 grand basic rate band, whereby she paid no higher rate tax on the income. So all we did, form a general partnership between the husband and wife, which is the most common kind of business structure other than being a sole trader. And because they're husband and wife, they had enough properties, they had complete flexibility to move the income profit share of that partnership every year or every month or every day. You've got complete flexibility. Very easy to set up. It just means you've got one additional tax return to do every year, rather than just doing 2 personal returns. You have to do the 2 personal returns still, but a partnership return as well. It maybe cost you, I don't know, there's some guys out there charging 200 quid for a tax return. It'd be very cheap annually to run, and it's got massive benefits when one spouse is a higher rate taxpayer and the other's a basic or 0% taxpayer, okay? Again, easy to set up. You don't have to refinance as part of this. And to be a general partnership, there is some criteria that you need to meet. You have to be classed as a business, and basically what that means is you need to be spending, on average, 10 hours a week on the property business, okay? So with one flat in London, you can't do this planning, okay? But if you've got maybe 4 or 5 properties and you're comfortable that you're spending those 10 hours a week on average, this planning, you know, makes sense for a lot of people, okay? Okay, next one, so LLPs. So I've maybe spoke not too favourably of LLPs already in this seminar. They are legitimate business structures, and when used correctly, they can have lots of benefits, okay? We use them for some of our clients, okay? And a lot of the time when people talk about LLPs, what they mean is a limited liability partnership, okay? So this is a bit of a halfway house between being a limited company and a general partnership, okay? So you have to submit accounts to a company's house, and it's seen as a corporate body. And you, or the individual landlord, would be one partner, or the technical term is member, and then the other partner is a limited company controlled by the same person, okay? So these two stick men are the same person, okay? Now, we use this structure when it's kind of a single person, they're just creeping into the higher rates of tax as a result of Section 24, okay? And maybe it's not cost effective for them to move their full portfolio to a limited company, but setting up this structure allows them to divert a percentage of the profits to the limited company member, okay? It's then taxed at limited company rates and gets some of the interest fully deducted, okay? And I think, like the slide says, yeah, it just takes the edge off Section 24, okay? The key issue when setting up this structure is that by diverting profits to the limited company member, although you're not moving legal ownership, because of the rules in Schedule 15 Finance Act 2003, there can still be a stamp duty charge when you divert profits to a limited company member of an LLP or a general partnership. So you need to be very careful with that. Again, the other firm are selling the LLP hybrid structure. That's a massive, or one of the massive issues I have with their structure, in that I believe if you're moving 75 or more than 50% of the profits to the limited company member, you're creating a big stamp duty charge on it. Now, from what I've seen, they do something clever with moving the income profit sharing ratio earlier in one day and later on the same day. It doesn't work. It works to the letter of the law, but not within the spirit of the legislation, in my opinion. Okay, but we'll leave that at that. Then the next big one is incorporation. So moving your full portfolio to a limited company. It's not right for the majority of people. For some people it is. And there is a double tax charge. When you start trading as a limited company, the company pays tax on the genuine profits with a deduction for the interest. But then if you want to take the money out, there is an income tax liability, dividend tax, or income tax on salary. So what you've got to do is do one calculation. If I stay in my personal name, what will my tax liability be without getting a deduction for interest payments and maybe going into 40%, compared with paying corporation tax, which come next year might be as high as 25%, and then income tax on the extraction, which as a married couple, and I do this myself, taking 100 grand out of a company, if you've got no other income, you can still do that and just pay 6% tax effectively because of the way the dividend rates work and so on. So it's not right for everybody. If you have 5 or more properties, again, if you're a business and you're spending 10 hours a week or more on the property business, then you might qualify for a capital gains tax relief, meaning there's no CGT to pay on the transfer. If you're in a partnership beforehand, like a married couple for instance, then you can avoid the stamp duty on transferring over as well. And a lot of the times there is no need to refinance when moving the properties over to the limited company. If this is of interest, then please do have a chat with me later today. Then very briefly, other ways to kind of reduce your tax liability, and a lot of people have done this already, moving your buy-to-let properties to serviced accommodation. Serviced accommodation, if you meet the taxation rules called furnished holiday lets, then the Section 24 adjustment does not apply to furnished holiday lets, so you can still get full income tax deduction for your mortgages, but it's obviously a lot more work to trade as a serviced accommodation unit than buy-to-let, more effort and so on. And then the next thing that I've been saying for a few years now, and in this last 6 months I'd say, a lot of people have been coming to me saying they're selling up, the tax changes on top of EPC, on top of maybe a recession coming with everything else that's going on. I am seeing a lot of people sell up, but the capital gains tax on selling properties is putting people off. So one thing that can be done, and again, it's probably a small fraction of people this would apply to, is you could transfer your properties to a limited company without paying any tax on the transfer based on the brief overview I gave a moment ago. And then the beauty of that is the company acquires the properties at, say, today's market value, if you did it today, okay? So you might have held it for 20 years, got big capital gains accrued on them, but it goes into the company with no tax to pay on the transfer. If you sell it, say, a year afterwards, after the properties have gone into the company is only taxed on the increase in value from when it's held the property, okay? So let's say property prices stay flat for a year, the company sells it, doesn't make a gain, therefore no tax. The only issue then is the money is in the company, okay? So if you want to get your hands on it, you've got to extract it and pay income tax on the extraction. But like I said earlier, you can take out, as a husband and wife, 100 grand from a company every year and pay only, I think it's 6.2% income tax on the extraction. So if you treat it almost like a pension and think, the only tax you're paying is 6% on these massive gains you've built up over 20 years, it can be a really good way of exiting for some people, okay? And then just to say, that was a bit of a whistle-stop tour on the different structures you could have and some of the pros and cons, but it's not all about taxation, obviously. There's commercial aspects to it. If you want to protect your wealth from, you know, say your son getting married to a gold digger, and you don't want her getting the money. You maybe wouldn't go to a general partnership. You might go limited company and have a shareholders agreement that kind of says only your bloodline can benefit from the properties. So it's not all about taxation, but they were just kind of the key benefits and risks from my point of view. Thanks very much.